These are in listen-only mode.
Good afternoon and welcome to today's Premium Account Market Update. The information is prepared for general information of traders and investors. The information does not take into consideration the specific needs, investment objectives or financial situation of any person. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter today, myself, Leon Hein, current Managing Director of Global Equity Management and the Investment Manager in the Investor Signals Unit Trust. The format for today's presentation, we do a quick summary of the global macro outlook with a particular focus today on the ASX Top 50 review, highlighting where we see FY14 earning per share growth and outlook, and we conclude with the portfolio allocations and the short-term Australian market outlook. The services that we provide are up on screen there, and if you'd like to know more about those, please contact either myself or Christine, info@investorsignals.com. Up on screen there, graph of the Dow Jones, and you would know from previous recordings that our base case is that we've been looking for about a 5 to 7% retracement in global equity markets, and we're some way into that at the moment. Our sort of bottom target here for the Dow is at around sort of 14 to maybe 14,500 is where we see fair value. We think that probably 10% EPS growth into 2014, which is where most analysts have US growth at the moment, is probably a little bit optimistic. At the moment, US GDP is probably likely to be tracking somewhere around 2 to maybe 2.5% on an annualized basis. The only point of note that I will highlight from a technical perspective is that the accumulation signal, which indicates volume coming in after a sell-off, which often is identified with a sort of a trough or a support level in the market. When you look back at prior signals, and they don't happen all that often, but during structural uptrends where you have higher highs and higher lows, you can see the last signal here was a good buying signal, as too was the case back in May, June last year. So we're presented again now with the accumulation signal, which suggests volume starting to build on this low. So from a pure technical standpoint, it would be associated with a good buying opportunity. When you overlay fundamentals and some of the issues at a macro level that are likely to buffer the market over the next month or so, I think you need to have some level of precaution that downside risks of another sort of 3% or so exist in the US market and also in the Australian equity market. So that kind of sets the picture there for our outlook for the US, and I'll just focus here again on the 10-year Treasury. So this is a real sort of barometer of how well the US market is recovering and the prospect of essentially the Federal Reserve pulling back on their bond buying program. The issue that we have here that I've spoken about is as the yields start to increase in the US, where we've had this tailwind coming from a strong property recovery, low corporate debt costs, and an improving consumer sentiment environment. If we start to see interest rates creep up too much in the US, combined with high costs of oil and gas as a result of sort of some of the tensions that are sitting there at a global level with Syria and Egypt and parts of the Middle East in general, a combination of high rates and high oil prices could be enough to cause equities to tread water for a while or even have some level of mild pullback. But so we continue to watch the 10 years as a gauge, somewhere around sort of 2.5 to 3%. I think is probably in an area that doesn't disrupt equities too much. So we continue to track that. And then just finally, from a macro standpoint, looking at the Australian market. Now, we trade on about a 4.5% forward yield. We're trading at about 14.5, 15 times 2014 earnings. So I think on balance, that makes our market reasonably expensive from historical standpoints, but obviously we have also to go with that on the flip side historically low yields in government bonds, which means that investors have little alternative than to focus around some of these higher yielding names. So as a general theme in the Australian market, the defensive yield plays, albeit at very high PEs, are still attractive, and a basic theme for us is to continue to own those names and sell covered calls. We see that the Australian market's reasonably full price up here. Downside risk is back to around 4,800. If you go back over the course of the last 6 to 8 months, we've really had a forecast at around 52 it's expensive, around 46, 4,800 it starts to get a little bit cheaper, and we have a view that for the most part up until sort of this November period the market will spend most of the time within this range. I think what will ultimately push the market out of this is some sort of synchronized global growth as we start to see aligned central bank policies eventually lead to a pickup in global GDP. All right, let's move straight into the top 50 stocks, and in today's recording the focus is we've essentially got through the bulk of earnings season here, and I've been focusing on providing the specific earnings results in the prior week's recording. Today's more of a summary as we attempt to sort of skip through the top 50 stocks reasonably quickly and provide sort of summary of the earnings and dividend yields and the outlook into 2014 and what our strategy is and derivative overlay for benefiting from sort of the portfolio allocations around these assets. So AGK, we were buyers of it at lower levels. At around $16, I think the stock's full value. It's just gone ex-dividend around 33 cents. We've sold the covered calls out into March. They're European, so we've just collected the current dividend. We'll collect the March dividend, and essentially our view here is that at around $14.50 the stock's cheap. Up at around $16 it starts to get expensive. At around $15.50 it puts it on a 4.5% dividend yield, allowing for about 10% earnings growth into 2014. I think it's unlikely that we're to see too much growth beyond that, so I think around this sort of $15.50 is where we see close to full value for AGK. Asiano was a good result from Asiano, driven by a lot of focus on cost control and cutting expenses in the business. It's not a name that we are preferring allocations to at the moment, but we continue to sort of watch the top line revenue growth of the business and look for that to improve in the next 6 to 12 months, or commentary out of management to say that that's improving before we sort of see Asiano as a investment in portfolios. Amcor, on the other hand, continue to like. And the real catalyst here for Amcor is the stock's expensive. It's on about a yield of around 4% for 2014. It's trading on a high PE of about 17 times earnings, but I think the pending split of the Australasian packaging distribution business will help to unlock some value. So I think we're reasonably safe even in a heightened sort of volatility or volatile backdrop in global markets. If we were to see further tensions escalate in Syria, or a bad outcome to the German elections, or problems in emerging markets. So it's always a thought process of how can we build a portfolio that gives us some exposure to upside growth, but is giving us a reasonable amount of defensiveness in a down market or a correction of any description. So Amcor fits that bill. We think the downside risks are reasonably limited, so we're owning it again at these levels, selling the $11 covered call into November. We've just collected roughly 20 cents of dividend payment in the last week or so, and we're also collecting around 22 cents for those $11 calls, so allowing for some capital growth here in Amcor, and into 2014 the company should grow at about 8 to 10% earnings per share. Amcor, their result came in at the upper end of the lowered guidance, so they'd really sort of prepared the market for the worst, and they slightly delivered a slight beat to that downgraded result. From an outlook standpoint, we don't see a lot of earnings growth. It's a yield story at around 24.25 the stock's value, based on it getting down to a 5.5% dividend yield. Up at around $5 it starts to get expensive relative to other assets that can deliver the same yield and a better growth profile. So it's really only a sideways sort of cash trade here on AMP, where to the extent that we're buyers of it at below $4.50 and then selling calls around the $4.75 level. ANZ on an outlook basis driving around maybe 3 to possibly as high as 5% earnings growth in 2014. I think on a yield tracking at around 5.5%. We've been owners of it at lower levels. We look to sell the covered calls into around the December period, the European style, so collect the upcoming November div. But I think the Australian banks in general are starting to look pretty full value again. ASX, so again, disappointing earnings from a growth standpoint, but largely that's something we had flagged where we're not expecting earnings growth out of ASX. Really as a yield play at about a 5.5% dividend yield. We expect reasonably flat revenue and reasonably flat earnings outlook into 2014. The stock's just gone ex-div around 80 cents, so we've collected that. Post this ex-div period, we'd expect it to be a little bit weak, but eventually tracking back up to around $35 a share to reflect that sort of fair value and 5.5% dividend yield. In most cases, we managed to get the calls away at around this 36.50 level. We collected an extra around 50-60 cents of income for that, so it's driving in excess of 10% cash flow per annum out of AGK with a base view that the stock largely trades within the range highlighted on screen there. AZJ, at around 450, we think the stock's just a little bit expensive. We had owned it at lower levels. We've essentially taken profit in most cases up at these levels. Any pullback back to around 425, we're happy to jump back into AZJ, and that remains our preference over Horizon. BHP, we own it at lower levels. I think at around sort of $36 to $39. We've sold covered calls. I think the stock, we were looking for it to pull back to $35 and consolidate and move sideways. I think the outlook for BHP should start to improve from that November through to early part of the new year, and we'd like to reposition those derivative overlays to capture further upside growth in BHP throughout 14 and throughout 15. From an earnings standpoint, the company should deliver about 10% EPS growth into 2014 and have it trading on a forward dividend yield of around 4%. Brambles, disappointed a little, probably more on the outlook statement. The company was guiding towards around 8 to 10% EPS growth. They delivered around 7%, but they downgraded the outlook to 4 to 5%. The real story here is the spin-off of the recall assets, which should happen prior to December. I think that sort of will see some level of re-rating in Brambles. We've been buyers of it on this dip down here at around 870. We've been selling the 925 calls out into November. We collect the upcoming 14-cent dividend, and we're collecting around 22 cents for those calls out into November, so giving us an effective exit price back up at around 950, after owning it at lower levels around 870. Again, I think this provides a reasonably defensive asset allocation in the face of sort of any weakness in global equities, and I think somewhat that will be supported by the spin-off of recall. CBA at 15 odd times earnings, it's expensive, but on a 5 and a bit % dividend yield, the stock's still attractive. I think it's largely just trade sideways in line with our view on the broader index. Coca-Cola missed earnings expectations. The market was looking for flat earnings. The company had delivered earnings that were down 10%. On an outlook, they've guided towards possibly another 4 to 5% earnings fall off in 2014. I think what we'll start to see is a lot better commentary out of the company on cost control. At around a 5.5% dividend yield, the stock can support a price of around $12.50. So we own it at this level, and we're selling the covered calls at around $13, again driving about 10% cash flow out of Coca-Cola. Not doing any CFX. Computershare, market was looking for 10 to 15% earnings growth. They came in at around 11% earnings growth for 2013. On an outlook basis, we're probably looking for the company to deliver high single digits in 14. I still think it's a buy down here at these levels, and we're selling the covered calls at around 10.50. And I think that's a strategy where we'd expect to see Computershare find support at or near this price point. CSL, the company's been very aggressive in the last few days as they conclude the last stage of their $900 million share buyback. They have extended a further $500 million. I have to comb through some data to see when they recommence that. I know they've probably only just concluded at around $18 million of buyback to go up until yesterday, so that's probably only just been concluded. I'd expect to see some fall off in the share price in between the conclusion of this current buyback and the beginning of the new buyback. I think whatever that trough period happens to be probably will represent an okay buying opportunity. CSL should grow at about 10% over the next year or two. The issue is it trades on extremely high PE, even on forward numbers up at around 20 times next year earnings. Crown not doing there at the moment, nor in Dexus Fortescue. So we've been mild owners of Fortescue at around this 470 level. I think it caps the upside recovery in this current rally based on our view that iron ore probably doesn't push too much above 140 a tonne in the short term. Fox going ex-dividend, I think at earnings per share growth into 2014 of around 8%. The real issue here, or the real positive for Fox, is the company's still got a further $4 billion of shares to buy back in FY14. I think any sell-off will be well supported by this, and therefore we're owners of it at or near these levels and selling tight covered calls over Fox. Goodman Group, I've highlighted that around 450 the stock starts to look fair value as the yield support comes in at around 4.5%. GPT, the same story here at around sort of this 350 level from a yield support and maybe 5% EPS growth into 2014. The stock looks okay value. IAG, out of the insurers, the margins here looked pretty solid. I think the stock's reasonably full value at this price point. We have it trading on about a 4.5% dividend yield into 2014 on a PE of around 12.5, 13 times earnings. So at around 550, we'd certainly be happy to take a look at IAG as a buy on the dip opportunity. Back up at around 590, we'd look to sell covered calls on it, but not doing anything right at the moment on IAG, nor doing anything in Iluka. IPL, I think, relative to the rest of the market, IPL continues to provide some reasonable value, trading on about a 4.5% dividend yield and only about 9 times 2014 earnings. But certainly the company's had a number of issues that have sort of impacted confidence of the market, which has obviously had a flow through to the PE valuation. So the Maramba plant has suffered some outages that are, whereas that would have normally sort of seen that added capacity flow through to further bottom line profits. The combination of the planned outages has essentially eroded sort of the benefit the company would have normally picked up from a weaker Aussie dollar and those added capacity numbers that would have been put on through the Maramba plant. Hopefully, the company's getting through the worst of that, and into 2014 and 15 we start to see some level of recovery in IPL, but it's certainly been a bit of a disappointing stock. Lendlease, on the other hand, we've been buyers of that throughout this recovery here at around 1050 to 1025 starts to look pretty full value in the short term. The market had kind of prepared for the worst after the company highlighting that they were unlikely to deliver any earnings growth, but the company made positive comments as to their 3-year outlook, and the market's interpreted that on the basis that the company can start to grow again at high single-digit earnings growth over the next 2 to 3 years. And with it trading on 9 times earnings down here, what we're seeing is a re-rating back to around 10.5 times earnings, which is where I think it'll find support. So looking for the stock to trade up towards around this $10 range. We own it at lower levels. We sold the calls at around $10.25 with a targeted exit price of around $10.50 using the premium from the covered call. MGR should deliver about 5% EPS growth, maybe as high as 7% EPS growth into 2014 at around a 5.5% dividend yield. The stock's reasonable value. If you want to get exposure to recovery in Australian property, Mirvac Group, Stockland and Lendlease are our preferred plays there. So Macquarie Group, we're not doing anything here at the moment. In some ways we sort of view this at the market's priced for perfection, so our preference is to sort of stay focused around Westpac, ANZ and NAB and CBA. and kind of avoid Macquarie right at the moment until we see some value reappear in the name. So NAB, we own it at lower levels. We sold the covered calls out into December at around this sort of 33 to 30 or 32 to $33 level. We'll go ex-div in this November period. The improvement in the outlook for the UK is helping to sort of see a gradual re-rating in the PE here of NAB to see it come more closely aligned with the other banking stocks. But at around a 6% dividend yield, NAB's well supported. From an EPS growth into 14, I think maybe again sort of that 3 to 5% is the target, but it looks to be sort of close to reasonably full value at present. Newcrest Mining, so the numbers are all up on screen there around their 2013 earnings. We're seeing a gradual recovery in gold prices, up around 10 to 12% from the recent lows. With gold recovering back to say $1,500 an ounce, I think we could see some material re-rating in Newcrest back up to sort of much higher levels. So we'll have to remain patient there. As sort of the contrary to the belief that the Federal Reserve is going to start pulling back on their stimulus or on their bond buying program. We've seen gold rally in the face of that nevertheless. So there's a view there that support levels being put in for gold, and it's certainly capable of trading back up and sort of into that 1,400 to 1,600 US an ounce, which should bode well for the outlook for Newcrest. Origin delivered a good earnings result, or at least an earnings result that met market expectations, but the real highlight was the company de-risking their involvement in future LNG projects from a capital expenditure standpoint, and greater assurance that new revenues will be coming online in 2015. At around a 4% dividend yield at around $13.50, I think Origin's reasonably full value. We've been owners of it at lower levels here, and we've sold calls short dated around the $13.50 level, longer dated into December around the $14.50 level, and I think that largely captures the recovery for Origin. From a PE standpoint, I have it trading at around 16 times 2014 earnings. So out of all the oil and gas plays, and clearly we're seeing a strong recovery in Oil Search, Santos, Origin, Woodside at the moment, from a valuation standpoint, Origin still provides the most compelling recovery story over the next 2 to 3 years within the LNG space. So whilst short term is pushing up against the top end of its valuation range, as is Oil Search and as is Santos, I think if we do end up delivering the stock under the strike of around that sort of $15 level, and an opportunity presented to buy back into Origin either later this year or early in the new year, we'd certainly look to continue to rotate capital into Origin on that basis that we think on a 3 to 5 year outlook, Origin should be reasonably well supported. Orica not doing there at the moment. Oil Search, as I mentioned, certainly more confidence building in the market that the Papua New Guinea LNG project will see revenues come online in 2014 and 15, but when we run the forward numbers on the earnings outlook into 2017 and look at the current valuations, again come to the view that Origin probably continues to provide the best upside. Qantas not doing there at the present. QBE slightly disappointing insurance margins. The company's had a long history of disappointing relative to market expectations, and we've just seen sort of more of that. We largely exited QBE a month ago, and I think that's proving to be the right view. Probably not until it gets down to sort of $13.50 to $14.50 will we start to see that it represents fair value, so not doing it there in QBE at the moment. Rio, so as iron ore recovers, Rio starts to improve, and fair value, and I've spent a lot of time in the past chatting about BHP and Rio being at a deep discount, relative to where we see future earnings growth. We're starting to see that correct. I think fair value for Rio is probably back up somewhere between sort of $65 and $70. I think BHP fair value is back up around sort of $37 to maybe $39. From a valuation standpoint, to put some numbers on it, both BHP and Rio looking for about 10 to 12% EPS growth in 2014. Rio's trading at about a 3 and a little bit percent dividend yield on 14 numbers and pushing back up towards sort of 9.5 times earnings, which starts to get at around sort of 10 times earnings. I think it starts to represent reasonably full value, and as a result of that, it's where we get to our price target of around $65. Stockland, so we're buyers of this at lower levels, so on an outlook into 14, looking for Stocklands to deliver about 5% earnings growth. We own it at around this 350 level. We've sold the covered calls at 370 into the end of September, and that was really a trade off the back of sort of the improving sentiment around the housing market. We'll reassess that post the end of September once we deliver the stock. If, on the other hand, the price pulls back a little bit from a cash flow standpoint of collecting the dividend and the call premium, we're driving around 10% cash flow out of Stockland. So we'll reassess that at the end of the month. Sonic Healthcare delivered a reasonably solid earnings result, well supported by its dividend yield. Getting a little bit expensive up at these levels. I think we'll see a readjustment back down to sort of this 1450 level. Happy to take another look at it then. Santos, expensive from a PE standpoint, pushing up to about 22 times next year's earnings. At the moment, we're in this middle of a sort of capital shift where we're seeing capital flow out of some of the defensive assets into this LNG space, so a little bit of a scramble on for Santos, Origin and Oil Search at the moment. I think you'll kind of get through this hot patch as far as asset allocations go, and we'll see some level of pullback in the months ahead. Suncorp, not doing there at present. Sydney Airport delivered a reasonable result, well supported by yield at around 375. Transurban were buyers of it at or near this level. I think as we push in towards the December dividend period, we'll see a recovery back up to around $7 in Transurban, supported by around a 4.5% dividend yield. Telstra, I think same thing. It's it's just gone ex-div 14 cents. We see this sort of often a little bit of a sell-off post the ex-div period. As we approach into the next dividend period, we'll start to see price rebuild at around a 5.5% dividend yield. I don't think there's too much more yield compression left in Telstra, so our strategy is to own it at this level but to sell the covered calls, and again that sort of drives that dividend yield or that cash flow up from 5% to around 10%. I think we're probably in this environment that we've been waiting for some time, where Telstra largely now consolidates, and that's a combination of mild revenue and mild profit growth inside the Telstra business, but also it's a function of the Australian bond yields probably hitting the bottom of their cycle at the moment, where on the forward yield curve the market's no longer pricing in significant rate reductions, and I think that starts to impact the way money managers, or the big money managers, allocate capital within the market. These yield names have had an enormous adjustment in price that's been disproportionate to their earnings growth, and that's really just been a function of the government bond yields or the interest on those yields falling to historical low levels. So I think to have a blind strategy of just chasing defensive yield name could be fraught with danger as we see the market start to sort of reprice the forward outlook for interest rates. In saying that, our case is that we think yields will probably remain fairly flat, and we're not probably likely to see an inflationary environment globally for some time. So we still want to own these names, but we're not going to get rewarded by capital growth. Therefore, we want to own them, sell the covered calls, collect the 10% cash flow out of them on an annualized basis, and at the right time sort of try to keep the asset mix in the portfolio skewed towards collecting sort of the benefits that come from some of the shorter term plays around Lendlease, Stocklands, BHP, Woodside Petroleum, some of those other names. So the outlook for Telstra into 14 is possibly mild dividend upgrade from 28 cents to maybe 29-30 cents, but the underlying business, excluding the NBN payments, is not delivering any real significant growth. Toll, Our strategy here is to own it around $5. At around $6 we think it's expensive, so again it's just one of these names where we don't see much more than about 5% EPS growth into 2014. So I think on a valuation basis, it puts the stock at about a 5% dividend yield into 14, trading at about 13 times earnings. So I don't think it's got the capacity to trade too much above $6, but equally the defensiveness of its revenue stream I think supports the stock at around $5. So we own it at or near these levels. We've sold the $6 calls, and again boosting that cash flow from 5% up to around 10% per annum out of toll. Westpac, in line with all the other banks, delivering about 3% EPS growth into 2014. From a dividend yield standpoint, getting down to around around 5.5% on forward numbers and around 13 times earnings. In some ways, Westpac's lagged some, NAB and possibly ANZ in this recovery, albeit it goes ex-div in the same time towards the end of this year. So as we look at the banking sector, probably out of all of them, if we were to see some level of sell-off just over the next month, buying Westpac sub sort of $30 would be an attractive opportunity that we would reconsider with a view of getting set in the stock again ahead of the upcoming dividend in November. But in saying that, we do own Westpac, we do own CBA, we do have some ANZ, and we do have some NAB exposure across the portfolios. So we're still exposed to the banking sector, just not in an overweight position at present. WDC, so the outlook here for around sort of 4.5% dividend yield, probably around somewhere around 3 to 4% earnings growth into 2014. I think the argument is the stocks should be well supported at around $11. Arguably, it's a beneficiary of a weak Aussie dollar, so we've seen the Aussie dollar pop back up from 89 back up to sort of 90, 91. That could at the margin be affecting sentiment around Westfield, but our base case is here at around sort of this 10.75. The stock should be well supported around 11.50. It gets expensive, so we sell the covered calls at around this $11.50 to $12 level towards the end of the year, and again boosting that cash flow up to 10% per annum. Wesfarmers. So Wesfarmers and Woolworths, I think, make a lot of sense from the point of view that the RBA is dropping rates, trying to stimulate consumer spending here in Australia. We're seeing good cost control. We're seeing good top-line margins. We've got a recovery in the property market, which should aid Bunnings, should help Woolworths with its hardware strategy. From an earnings standpoint, the market was looking for about 10% EP earnings per share growth in 13 from Wesfarmers. They delivered just over 6%. From a valuation standpoint, what that means is the stock's trading about 19 times 2014 earnings, which is a very high multiple. But again, relative to bond yields, when you consider Wesfarmers is yielding at almost 5% on 2014 numbers, the stock still will be very well supported at around this $39 level. So we're happy to own it at or near this level, and we're selling the covered calls up at around $41, $42. I think the probability of the stock pushing too much above that in the next sort of 3 to 4 months is a little bit limited, but we continue to like Woolworths and Wesfarmers as defensive names that are likely to move sideways that we can own and sell the covered calls against and drive that cash flow up. So, and on that, Woolworths excited the market a little bit with their combination of the earnings growth coming in at around sort of 6 to 7% for 13, whereas there was concerns that that could be as low as sort of 4 to 5%. Generally, all areas of the business were delivering good earnings growth, and the outlook statement for the company, they marginally upgraded their 2014 earnings bracket from 4 to 6% to 4 to 7%. They're one of the last stocks to pay their dividends, so we're seeing capital flow into Woolworths ahead of the upcoming dividend, but the stock is extremely expensive. So when you allow for around 5% earnings growth into 2014, the stock's trading at about 18 times earnings on just under a 4% dividend yield. So fair value for Woolworths, even in light of a more sort of optimistic outlook, I think is probably back at about $34. So we look for the stock to go ex-div. To the extent that we've been buyers of it at or near these levels back here, which we're reasonably aggressive at, buyers or accumulators of the stock at around this $32, $33 level. We've sold the covered calls anywhere from sort of $34.50 up to $35.50 in the European style. So once we strip out the upcoming div, I think we're sitting in the right price there where Woolworths is likely to sort of consolidate back at around $34. Woodside Petroleum, around 7% earnings growth. The market was maybe looking for 10 to 12% earnings growth into 14. That number's probably going to be high single digit, but I think right at the moment with the tension in the Middle East, we're seeing sort of a disproportionate capital flow into some of these oil and gas names at the moment, and I think that probably continues. So our base case here for Woodside is that it's worth somewhere between $38 and $40. I think at best, or there's a chance that it just consolidates and moves sideways, but ultimately I could see Woodside into the early part of the new year tracking back up to around $42, and that fits in with our broad thesis that we would expect to see BHP also back up at similar price levels around $40 to $41 into the early part of the new year. And Westfield Retail, so just to jump back on Westfield Retail, interesting, around 6% dividend yield. There's not a lot of earnings growth here, maybe about 1%, 2% earnings growth into 14. The stock trades at a reasonable discount to its net tangible asset. Ordinarily that probably wouldn't close up any given sort of some of the concerns or the softness in the outlook for the Australian retail and commercial property market at the moment. However, the company's just recommenced its share buyback yesterday, so I think at the margin the stock should be reasonably well supported at around this 290 level. We're looking for it to rally back up to around 310, which is where we see sort of fair value as the stock sort of recovers into sort of the next sort of 3 to 4 month period. And just finally to conclude on a short-term market outlook from a technical perspective, now quite different to the US where we had the sort of higher high, higher low, and I spoke in the beginning of the recording about the buying pattern occurring. The Australian market has a slightly different scenario where we've gone down, made a lower low, we've rallied back up and made a lower high. Now here's the shorting signal here. And ordinarily that would result in some level of fall in the market, and that sort of feeds into our view that the XJO could fall back down to around 4,800. Interesting that from a technical standpoint, just when it looked like the market was maybe starting to fall, we've had a breakout rally to the upside again. So it'll be interesting to see whether ultimately what we're looking at is a more stronger recovery in the Australian market, which will be supported by a recovering global picture, or in fact whether our base case is that the market sort of treads sideways and we're prepared for sort of some risks to maybe 3 to 5% fall, but ultimately as we get into the latter part of this year or early new year, we'd expect synchronized global growth and a pickup in global GDP to underpin probably a recovery in our market that pushes it back up to sort of 5,600 towards the end of 2014. Thank you for listening in, and I look forward to speaking again next week.